I think the first question for me is, a lot of people say insurance is not investing. And there are a lot of debates. I'm sure if you were to have a debate like that on X, formerly Twitter, you would have a lot of opinions coming your way. I think to ask you, are they right? Is insurance investing or?
Thank you. So as we think about insurance today, I want to say that financial planning encompasses 3 levels of your planning. The first level is where you do accumulation of your assets. The next level is where you grow the portfolio. And the third pillar is what you call conservation or protection. Let me talk briefly about accumulation. You can accumulate your wealth contractually or non-contractually. A contractual avenue of building your wealth is where you get into a contract, knowing too well that I want to get into this kind of a plan, run for 10 years, it run for 5 years, it run for 20 years. The objective is to raise this kind of amount. And every month or every quarter or every year, I'll be putting in this kind of a premium. That is a contractual arrangement. At the expiry of the contract, of course, depending on the terms and conditions, you'll be paid back your money, or in the event of a death claim or disability, you'll be compensated, or your family will be compensated. Now, the second level is now where you have to grow your portfolio. Yes, you have put aside. How do you grow it? Many people will have avenues that will either be the short-term avenues or the long-term avenues. I'll be looking at maybe an avenue like a money market, which is a short-term avenue. You want to build an emergency fund, for example, and you've decided to put aside a certain amount of money the next 1 year. And the idea is to build maybe an emergency fund with a threshold of 3 to 6 times of your monthly financial requirements. Another person may be building the fund for educating the children, and the children will go to school in maybe the next 5 years, the next 10 years. Again, that's a different platform. Somebody else will also be investing or be accumulating with the purpose of building a retirement fund. Maybe that is coming in the next 10, 15 years. I think the whole idea and mechanism of knowing what particular financial solution to take at what stage is very, very important. Because at the entry point, I think everyone's agenda is to try and accumulate. But as you accumulate, you are aware of the risks that you're exposed to. That between now and the next maybe 5 years, between now and the next maybe 10 years, what risks am I exposed to? 1, I could die. 2, I could get disabled. 3, I could get into critical illness. When you think about such risks and you've got that primary agenda that you wanted to achieve, how do I then navigate through this journey to the 10th year, given that there are many risks on this path? That is not where the insurance element comes in. So generally speaking, there are so many people in Kenya that are making effort to build their investments. Unfortunately, if you build your investments in an environment where you don't have additional security to take care of you in the event of any occurrence, then the challenge again comes your way. People actually need to understand that insurance has got its own space. That as build your portfolio, you have to be careful of the risks that you're exposed to. Because you may work so hard and still not achieve the agenda, because the risks on your path are likely to deplete the portfolio that you've built over the years. So for me, the risk management and investment, they go together. You cannot separate them. And if you work with one without the other, ultimately that would be a very shaky investment program or a very shaky financial position, because you'll get there, but because of a risk, you are brought down. Again, you also don't want a scenario where you'll only take care of the risks and not take care of the investment.
True. There's a balance. There's a balancing act
industry, too. We call this the contractual investments that combine the insurance and assurance element. That in the event anything happens to you, there's a payout. If nothing happens to you, you still have the payback.
Yes, you still have the payback. You get back your premiums. You're not,
again,
you're not
a lot of people
burning
don't
money.
Understand. When we talk about a life insurance policy, people only imagine that you'll be paying premiums for a certain duration, and if nothing happens to you,
then nothing, it's gone.
That's not the case. It will only be the case if you've taken a pure life insurance cover. If you take a pure life insurance cover that has no investment element, then it means that you're covering the risks, and in the absence of those risks within the contractual period, there's no payout. But when you take the assurance and the insurance together, that in the event nothing happens to me, I have this investment element that is also ongoing. That element will actually pay you back with this profit.
You raise an important matter of distinguishing between insurance and assurance. I think insurance, many of us get it. If it's a car, I insure if anything happens to the car, it's a write-off, I'm paid. If it's medical, I have a card here at work. I present it at the hospital. I don't have to pay out of pocket. I'm sorted. But when it comes to the long-term plans, and specifically life policies and education policies, like you said, these are assurances. Whether now or later, that's due to happen.
True.
And if you have children, you have to pay fees for them,
That
effectively.